friends, welcome to RV Academy. Hi students, in my previous video I explained what is cash flow statement and how to find out cash from operating activity, financial activity, investment activity. Also we did two problems on operating activity and financing activity. Now let us take one problem which carries for 15 marks. This has been taken from 2017 question paper, question number 9. Just look at this problem. As per AS3, from the following balance sheet of Nagarna Limited and the additional information, prepare cash flow statement. Liabilities 31/3/2015, 31/3/2016. Assets 31/3/2015, 31/3/2016. Equity share capital opening 13 lakhs, closing 15 lakhs. General reserves 2 lakhs, 2 lakh 50. Profit and loss account 1 lakh 20, 1 lakh 80. Bank loan long term 3 lakhs, 2 lakhs. Creditors 1 lakh, 1 lakh 60. Bills payable 80,000, 60,000. Proposed dividends 1 lakh, 1 lakh 75. Provision for taxation 45,000, 60,000. Goodwill 30,000, 20,000. Land and building 7 lakh 50, 10 lakhs. Plant and machinery 6 lakhs, 8 lakhs. Investments 1 lakh 35, 1 lakh. Stock 3 lakh 30, 2 lakh 30. Debtors 2 lakh 30, 3 lakh 32,000. Cash and bank 1 lakh 50, 88,000. Preliminary expenses 20,000, 15,000. Total 22 lakh 45,000, 25 lakh 85,000. Additional information, depreciation written off on plant and machinery is rupees 1 lakh 20,000. Equity shares were issued against the acquisition of assets of another company. The assets acquired consisted of land and building 1 lakh 50 and stock 50,000. No depreciation has been charged on land and building during the year. A dividend of rupees 13,500 was received during the year. Proposed dividends and provision for taxation shall be treated as non-current liability. This is one kind of a problem which is usually asked for 14 marks section C. Now, before I go to the answer, I will tell you some of the important points. Don't create all the accounts at a stretch. So, equity share account or long-term loan account, any accounts you don't create. How to create the account? Which are the accounts to be created? First, you just look at the adjustments. If there is certain adjustments given with regards to a particular item or particular asset or liability, then you create an account to find out the missing information. There will be some information which will be missing. They will not mention anywhere. To find out the missing information, we need to create the account. Here, the first adjustment, you can see depreciation written off on plant and machinery is given. So, I will create the plant and machinery account. Opening balance I have taken from the balance sheet. Anything which you take from the asset side, opening always comes on the debit side because all assets are debit balances. Begin with the debit side. To balance brought down 6 lakhs and obviously closing balance comes on the credit side. Anything which you take it from the asset side, you have to begin with the debit side. Anything which you take it from the liability side, you have to begin with the credit side because all assets are debit balances, all liabilities are credit balances. 6 lakhs and 8 lakhs, these information is available in the balance sheet. Opening balance 6 lakhs, closing balance 8 lakhs. And look at the adjustment. Depreciation written off on plant and machinery 1 lakh 20 is given, 1 lakh 20. Apart from that, nothing else is given with regards to plant and machinery. Now, find the total. Which side is more? Credit side is more. Credit side is more by 3 lakh 20,000. How? 8 plus 1 lakh 20, 9 lakh 20. Total 9 lakh 20 has been written here. Some information is missing. 9 lakh 20 minus 6 lakhs comes to 3 lakh 20,000. This is nothing but purchases to bank, purchase balancing figure. Some asset is purchased during the previous year. That information has been not mentioned anywhere in the problem, which we should find out by creating an account. That is first step. In case if this side is less, it is assumed to be purchases. If this side is less, then it is assumed to be either depreciation. If depreciation is given, it is considered to be sales. If depreciation is given and this side is less, then it becomes a sales. If sales is given, then the difference becomes depreciation. If depreciation and sales is given, the difference becomes the loss. Okay, so this is how we have to create the account. The first account I created, I found the missing value of 3,20,000. It is nothing but purchases balancing figure. Now, second one, equity shares were issued against the acquisition of assets of another company. The assets acquired consisted of land and building 1,50,000, stock 50. So I created a land and building account here. Again, opening balance 7,50,000 and closing balance is 10 lakhs. Opening balance 7,50,000, closing balance 10 lakhs, which I took it from the balance sheet. And they issued a shares and purchased the land and building. In other words, they purchased the land and building. In return, they have given a shares instead of cash. It is not purchased by cash, but it is by shares. Instead of cash, they issued a shares. Now, apart from that, there is no other adjustment. There is no depreciation on land and building. Now, when you look at the difference, this side it comes to 10 lakhs. This side, opening balance plus this information. These two information available. When you add up these two, it comes to 9 lakhs. 1 lakh is missing on this side. That is nothing but purchases to bank, purchases, balancing figure. It is nothing but balancing figure. In other words, during the previous year or in the current year, they purchased 2,50,000 worth of land or building. Out of that, 1,50,000 is purchased from shares and 1 lakh rupees out of cash. So this information is not available. We should find out. This information was missing. We should find out by creating the land and building account. Now, we go to equity shares account because equity shares also is given the adjustment. Balance comes on the credit side because it is a liability. Anything which you take it from the liability side, opening comes on the credit side, closing comes on the debit side. By balance brought down 13 lakhs. To balance carried down 15 lakhs. Now, see the adjustment. Equity shares were issued against the acquisition of assets of another company. Assets acquired consisted of land and building 1,50,000. Land and building, buy land and building 1,50,000 and stock 50,000. So total 15 lakhs. It is matching on both the sides. No need to worry at all. So both the sides it is equal, so that there is no problem. First, before you go for the cash flow statement, you have to prepare the adjustments for the various accounts. Then the cash flow statement becomes very easy. Now I will go for cash flow statement. In the cash flow statement, already I told you there are three parts. First part is cash from operating activity. That is from manufacturing, buying, selling or main activity of the business, from which anything which comes into the business is called from operating activity. And to this we have to make the working capital changes. Increase or decrease in working capital should be adjusted here, by which we get cash from operating activity part A. Part B, cash from investment activity, that is nothing but purchase and sale of fixed asset. If fixed assets are purchased, it's outflow of cash. If fixed assets are sold, it's inflow of cash. So purchase and sale of fixed asset comes in the investment activity. Any changes in the long-term liability, that is increase or decrease in the long-term liability, comes in the financial activity. Now, before I go to that, just look at the balance sheet. Which are the items comes into which activity we will classify. Equity share capital goes to financial activity. General reserve P&L account goes to operating activity. Bank loan long term goes to financial activity. Creditors and bills payable goes to the operating activity. Proposed dividends, provision for taxation is considered to be non-current liability as per the problem. Otherwise, we could have taken it as a current liability. So here proposed dividends goes to financial activity and provision for taxation, opening and closing, will be taken in the operating activity itself. I'll tell you how to do this. When you come to the asset side, goodwill goes to operating activity. Goodwill is an intangible asset. Anything which is written off goes to operating activity. Land and building, plant and machinery, investment goes to investment activity. Stock and debtors goes to the operating activity. Don't take cash and bank balance. We have to write this at the end. At the end of the problem, preliminary expenses goes to the operating activity. Now let us see how to work out the problem. First you take the net profit. Net profit, that is difference between the closing and opening balance of P&L account. Profit and loss account given as 1,80,000 and 1,20,000. 1,80,000 minus 1,20,000 is the profit earned by the business for the year, which included non-cash or non-operating incomes and non-cash or non-operating expenses. Which are those non-cash or non-operating expenses? First, add back all non-cash or non-operating expenses because previously it has been deducted by the financial accountant. Now go through the problem. General reserve 2 lakhs and 2 lakh 50. 50,000 has been transferred from profit and loss account to general reserve account. It is a non-cash and non-operating expenses. General reserve 50,000 is added back to the profit. Then go to other parts. Bank loan, creditors, bills payable. Proposed dividends, they ask us to consider this as a non-cash or non-current liability. That is why proposed dividend, if you propose this year, it will be paid in the next year. Last year, whatever is proposed is paid during the year. So that what I will do is, the current year proposed dividend means it is just proposed, not yet paid. Cash is with us, it is not yet paid. So 1,75,000 proposed dividends should be added back to the profit. In other words, out of profit, 1,75,000 has been kept aside for the purpose of proposed dividends. That should be added back to the profit. Similarly, provision for taxation. To make the income tax payment or advance taxes, 60,000 has been kept aside. Provision is made, but it is not going to affect our cash. Just the profit has been kept aside to make the payment. So you should add back to the profit. So proposed dividends for the current year, provision for taxation for the current year should be added back to the profit. Now what will happen? Net profit before tax. We get net profit before tax. To this we have to make all the other adjustments like add non-cash or non-operating expenses. Non-cash or non-operating expenses. So expenses which is deducted earlier should be added back to the profit, which does not affect our cash. What are those items? Here goodwill 30,000, 20,000, 10,000 is written off out of the profit as a goodwill. Goodwill written off does not affect our cash, so add back to the profit. Then land and building, there is no any depreciation has been charged on land and building. There is no any loss or profit on sale or purchase of land and building, so need not worry. Plant and machinery, of course we have an adjustment. Go to the account which already I prepared. In the plant and machinery account, credit side we have depreciation on plant and machinery. It is a non-cash expenditure. It does not affect the cash. So add back to the profit. Depreciation on plant and machinery 1,20,000. Then investment of course decreased. Assume that it is sold. 35,000 rupees is decreased. We assume that it is sold. Stock and debtors is a current asset. Cash at bank, we will take it at the end. Preliminary expenses is a deferred revenue expenditure. 20,000 is decreased to 15,000. So that means 5,000 is written off out of the profit during the year. It is a non-operating expenditure and non-cash expenditure. Preliminary expenses written off should be added back to the profit 5,000. When you add all this, 1,35,000 which is deducted earlier by the financial accountant. Now I am adding back because it does not affect our cash and it is non-operating expenses. Non-cash or non-operating income which is added by the financial accountant earlier, now we have to deduct because it is not earned out of the operating activity. Nothing is here, but in the adjustment, a dividend of rupees 13,500 was received during the year. Dividend received is not from regular activity of the business or operating activity of the business. So dividend received 13,500, you deduct from 4,80,000 because it was added by the financial accountant earlier. Now I will deduct to get operating profit before working capital changes. In fund flow statement, whatever P&L adjustment you prepare and find out fund from operation, that will be equivalent to this. It's nothing but we take the opening balance of P&L on the credit side and closing balance on the debit side. All these items like provision for taxation, general reserve, proposed dividends, all these items we debit in the P&L adjustment and this will be credited. So when you add up and deduct the debit side minus credit side, you get fund from operation there, but here we call it as net profit before working capital changes. From here onwards, whatever you prepared like schedule of changes in working capital, that part will be adjusted here itself. There is no separate account is prepared, like separate statement is prepared like working capital changes. Increase in current liability and decrease in current asset results in inflow of cash. If current liability is increasing, current assets are decreasing, cash comes in, cash inflows. Just look at this problem. Sundry creditors or creditors 1 lakh and 1,60,000. Sundry creditors is increased by 60,000, it is inflow of cash. Similarly, bills payable 80,000 to 60,000 decrease. Decrease in current liabilities outflow of cash, decrease in BP 20,000. Then goodwill, land and building, plant and machinery investment. Stock. Carefully observe. Stock to 3,30,000 and 2,30,000. In 2,30,000, company is issued shares. In return, they purchased land and building worth 1,50,000 and 50,000 worth of stock. So this 2,30,000 which included that 50,000 rupees, first we have to adjust that because it is not to be considered as a current asset. 50,000 worth is not purchased out of cash. That is why 2,30,000 minus 50, you get 1,80,000. 1,80,000 minus 3,30,000, you get 1,50,000. Decrease in stock is an inflow of cash. Anything which is purchased out of shares, first you adjust that value. 2,30,000 rupees is the closing balance which included 50,000 stock purchased by issue of shares. Adjust that. 50,000 minus, you get 1,80,000 is the actual closing stock of cash. Then minus 3,30,000, you get 1,50,000. When you add these two, it comes to 2,10,000, 4,66,500 minus 2,10,000, 6,76,500 is the answer. Debtors is decreased 2,30,000. Debtors is increased 2,30,000 to 3,32,000. Increase in debtors 1,02,000. When you add these two, it becomes 1,22,000. We have to minus this. Minus, you get operating profit before tax 5,54,500. In this, we have to adjust the tax payment. Cash from operating activity before tax 5,54,500. Now see provision for taxation, opening balance. We added closing balance as non-cash or non-operating expenditure, and 45,000 last year whatever they made a provision is paid during the year minus tax paid 45,000. The final answer comes to 5,09,500, that is cash from operating activity A. If you are thorough with this part, rest of the two parts very easy. It's not at all a problem. You try to learn more with the part A. cash from operating activity, part A, 5,09,500. Now the second part, cash from investment activity. Any purchase and sale of fixed assets comes in the investment activity. If fixed assets are sold, inflow of cash. If fixed assets are purchased, outflow of cash. So here, land and building. Goodwill, of course, intangible, it is written off. You need not worry about that. Land and building purchased by cash. Don't take purchase of land and building by shares. It is not inflow of cash or it is not outflow of cash. We purchased land and building and issued shares. Both issue of shares as well as purchase of land and building and stock are not to be considered. Only cash inflows and outflows are considered in the cash flow statement. Purchase of land and building by cash, 1 lakh. Take 1 lakh rupee and go to the plant and machinery. Plant and machinery account, purchased 3,20,000, outflow of cash. Purchase of plant and machinery by cash, 3,20,000. And just look at the investment, 1,35,000 is decreased to 1 lakh. That means 35,000 worth of investment is sold. Sale of investment, 35,000. When you add these two and deduct, it comes to 3,85,000. That is cash from investment activity. Any changes in fixed assets comes under the head cash from investment activity. Here two assets were purchased, that is land and building and plant and machinery, and one asset is sold. When you purchase, outflow of cash. When you sell, inflow of cash. The net answer is 3,85,000, outflow of cash from investment activity. The last part is cash from financing activity, bank loan paid. Go to the liability side. There is a issue of 2 lakh rupee equity shares. We don't consider that. In this, 2 lakh rupee equity shares are issued. In return, they purchased land and building and stock. Land and building, stock and shares. These three we will not going to consider. General reserve P&L account is already considered. Bank loan, long term, 3 lakhs to 2 lakhs, 1 lakh rupee is paid back. So outflow of cash, bank loan paid, 1 lakh. Any changes in the long term liability comes in the financial activity. Bank loan paid, 1 lakh. Creditors, bills payable, already we have taken into consideration. Proposed dividend. Last year, whatever dividend is proposed is paid during the year. Dividend paid, 1 lakh. So current year proposed dividends is added back to the profit, and this dividend should be deducted out of the profit because this year we make the payment. Dividend paid. Provision for tax, of course, we have already considered. Apart from this, dividend received 13,500. In the adjustment it is given. In the first instance, we considered that as a non-operating income and deducted out of the operating profit. Though it is a non-operating income, cash is received by the business. So that we have to add back to the profit. Cash, dividend received 13,500. The final answer, 2 lakhs minus 13,500, it comes to 1,86,500. Cash from financing activity, part C. This is part C. We calculated part A, part B, part C. Now, net cash flow A plus B plus C. Here, these two are the negative values, minus values. And this is a positive value, plus value. Add these two and deduct this. There is a outflow of cash 62,000 during the previous year. Net cash flow, that is net cash outflow 62,000. Please carefully observe, we have not considered cash and bank balances as a current asset and not adjusted in the working capital. Here we have to take that. Add opening cash and bank balance 1,50,000. 1,50,000 is the positive value, this is negative value, this is positive value. 1,50,000 minus 62 comes to 88,000. This is equal to your closing balance of cash, whatever is given in the balance sheet. Your answer should tally with this 88,000. Now, what is the advantage of preparing the cash flow statement here? That is very important to understand, not solving the problem. You should know why we have to prepare. From which activity the cash inflows are coming in, from which activity the cash outflows are more. From operating activity, of course, there is a cash inflow, 5,09,500 rupees they received cash from operating activity. But when you look at the investment activity and financial activity, there is a cash outflow, huge cash outflow from investment activity 3,85,000 and financial activity 1,86,500. So if they could have avoided this, there will be a sufficient cash in the business. Because of these two, cash outflow, more cash outflow of 62,000 which affected the operating activity 5,09,000. So there is an outflow of cash. This is not a good trend for the business. They should have the control over the cash. Please like, share and subscribe my video. Thank you. Some of the book I published for BCom and BBA of BCU and BO for Skyward and Sapna Book House. Please make use of it.